Hello, everybody. My guest today is Ross Buhrdorf, CEO at Zen Business, which democratizes entrepreneurship by making it easy to create, maintain, and manage an LLC or other corporate entity. With more than 30 years as an entrepreneur, technology leader, C-level exec, angel investor, and board member, Ross has been at the forefront of how consumers interact with technology. Most recently, as the founding CTO of Homeaway, one of Austin's most iconic tech companies, he was responsible for building both the team and the tech platform that powered the company from a startup through IPO to its current recent acquisition by Expedia for a whopping $3.9 billion. Ross, you ready to take us to the top?
Hey, you bet. I'm ready.
All right. Well, first off, I love that you're in Austin. I'm down here as well. Talk to me quickly about Homeaway. So you have kind of Homeaway, you got Ronnie at Indeed. There's not a lot of billion-dollar exits happening in Austin these days.
No, there isn't. I mean, this was just really, we were part of the Unicorn Club. You know, took it through the raising of $350 million, took it through the IPO, and then the ultimate sale. It was really quite a ride there, 10 plus years, you know, built it from the ground up. I don't know. It's just, you know, when you've got a good idea like a Homeaway and vacation rentals, we really created that market segment that now a lot of folks are disrupting, but just a great ride, great experience.
Why didn't you stay with kind of Barry Diller and IAC and kind of the Expedia clan?
Well, you know, after 10 plus years, all of the executives exited. So when we sold, we all exited. Brian stayed around for a year in transition. And I really think that there is a time when, you know, there's folks that build stuff and then there's folks that take it to the next level. And, you know, I think Expedia is doing a fantastic job of taking it to the next level with what they do. You know, I think they're doing a great job, and we left them a fantastic company with a ton of pent up revenue that's really doing well for them and their shareholders. But I'd have to kill myself if I was still there.
How old are you when you guys founded Homeaway?
Oh my God, that's you know, I'm getting ready to turn 55, so that was over 12 years ago. Do the math.
Okay. No, the reason I bring that up is everyone thinks you have to be like someone like me, right out of your dorm room, super young to launch like a huge company. But there are so many entrepreneurs that start their mid 40s or even early 50s that create huge companies. You're one of those, early 40s, it sounds like.
Yeah. Now, you know, I started early on. I was at Excite.com, which was during the first internet boom that, you know, was a multi-billion dollar. I think at the peak of its valuation, it was either $7 or $9 billion valuation. So through multiple acquisitions. So, I mean, I've been around. I will tell you, if you look at all of the founders at Homeaway, I was the youngest of the executives.
Yeah. I bet you made sure they knew that too.
I reminded them that all of the time.
Now the question was, did you convert your young age and say, listen, I'm the youngest here. I deserve the most equity because I'm the youngest and I have the most to gain over a long period of time, right?
No, it was really, that didn't work out that way. It was more of like, I'm the youngest, so I'm definitely the smartest here. And you know,
that's
that
funny.
Didn't work either, but I still tried it.
Well, that's great. Well, listen, I have a lot of respect for what you built. You know, there's kind of a clan of CTOs forming in Austin that have done this. I was just at the Eberly with Jason Cohen, you know, eating with obviously WP Engine CTO. And, you know, the stories here are incredible. So let's jump into your current business. Okay. So first question I have for you, did you launch Zen Business from scratch?
No. Well, the answer is yes, in a certain sense. I bought into the company, so I invested in the company. But when I invested into the company, you know, literally 3 months as part of the investment, I was going to do a pivot and then pivot again. So really it was, I would say, had some IP that we needed, had a lot of experience, was definitely in the area that we were in, but the customer facing part was wrong. And so that's what we discovered and pivoted. It's actually has turned out pretty well. We had great investors already on the cap table.
Ross, what year was this, by the way?
That's been 2016. The end of 2016, I joined up as the CEO.
So just to be clear, you had the first time you invested was 2016, or you were an investor prior to that and you took over as CEO in 2016?
I invested and took over as CEO at the same time.
I see. Okay. How much did you invest in 2016?
Well, I put in 25 grand and then they were in Capital Factory. So there was a match out of that because I was also a partner in Capital Factory.
Oh, I see. Interesting. Very interesting. Okay. Now, did you actually you bought in, they issued you a big chunk of equity, or did you actually figure out a way to clean the cap table, buy out all the early investors, and then have this be your baby?
No, there wasn't that much money in. I mean, there was hundreds of thousands of dollars in, but I really didn't feel good about wiping out the existing investors. They were good investors. I wouldn't have bought into the company had I not thought it was a good base to build on. I could have wiped them out. And I am definitely a bloodthirsty capitalist. Don't get me wrong here.
Well, but Ross, let me change the verbiage for a second. Let me change the verbiage because I'm not talking about wipe out. I'm talking about like your biggest asset, I imagine, is cash based off the exit. So if you can, it's not worth your time to put 25 grand in a company, own 3%, and then work for 5 years building Zen Business. It is worth your time to put in, I don't know, $1 million to buy the whole company, give 20% back to the founding team. You hold 80 and then you build it that way. I'm trying to figure out why you chose not to do the latter.
Yeah. I'm offended when you said that my biggest asset is money. I do have a lot of money, but my biggest asset...
Sorry, is time. That's what I meant.
So my biggest asset was really me coming in as the CEO, and I took in a bunch of equity.
Oh, so okay.
I have the majority of equity.
Oh, I see.
In the company. I put the 25 grand in at the time they were on the skid. And, I put them in one of my rental houses that we used as an office here in town and really bootstrapped while we went out and raised money and discovered the market. I mean, there was already a really great market and a great neighborhood that the company was involved in. It really just needed to be pivoted to where we, acquire our customers at the top of the funnel when they do formation.
Yep. Now, you just did in February this would have been February last year. You did a $4.5 million round, I believe. So how much capital into the company after you kind of put in your original 25K?
How much was in?
No, how much more has been added?
Probably 4 million of that. So I raised $4 million.
Yeah.
I think there was actually 350 or something like that in the company prior to me investing. And then I raised a bunch from, Austin, friends and family. What I really did was all of the people that I'd written checks, I went back to them and I said, okay, now it's time to pay.
Yeah, that's funny. Okay, and by the way, you should bet on me. Here's what I just did with Homeaway, right? It should be an easy check.
Exactly.
Yep.
And
okay.
We started getting bite in the market in the end of 2017. I'm a big proponent of testing. Oh my God, we had like 16 sites going up at one time. We were abusing customers, figuring stuff out. I remember JC, the head of sales here, came to me and he said, "Hey man, I think Stripe is going to shut us off." And I said, "Why in the hell Stripe?" "Well, because we're getting so many chargebacks." And I said, "Why are we getting chargebacks?" And he said, "You remember that product we sold for like $500 a year?" And I said, "Oh shit, refund all their money." We had to go back and refund all their money of all these customers. So we got bite in the market, and then we went out and we were growing 10% week on week with the money we had. And that's what we went out and raised money, launched the product. The start of the product you see today, really.
That is funny. Okay, so what's the average customer paying you guys today for your services?
Let's see. I don't have that number right in front of me.
A range is fine. Is it about 110 a year?
Oh, more. Well, when you say average subscription, so the way that we look at it is our average subscription per customer is hang on a second here, is $17.25
a month.
Yes.
Okay.
A month. So you got to realize the one product, what we're after is getting people at the top of the funnel when they do formation. We really are this SMB platform for the long tail of solopreneurs, entrepreneurs, real estate folks. So there's no reason you shouldn't use us, because we do the formation for free. But then once you do the formation, we sell you products like banking, insurance, accounting, tax prep, EIN numbers. So we sell you all of the services you need as a small business.
And what have you scaled to today in terms of total customers?
We just went over 6,000 customers.
Oh, great. So can I multiply that 6,000 times 1725? You're doing about 100 grand a month right now?
Yes.
Okay.
I'm not trying to give you out all those numbers. I'm getting ready to do a fundraise here pretty quick. but you're in the ballpark.
Okay. And generally speaking,
just to be clear around our business model, 2/3 of our revenue is subscription revenue. We have a lot of transactional revenue too. So our revenue is well north of those numbers you just quoted.
but the pure SaaS is $17.25 average per month.
Yes.
Okay, got it. Yeah. So you're doing north, obviously, of what we just disclosed, but this is the pure play SaaS component. And if we talk about just the pure play SaaS component a year ago, did you double it or triple it or quadruple it year over year? What's the growth?
We've been growing on average 35% month on month.
So yeah, help make that math easy for me. So a year ago, what were you doing monthly?
Think of it starting in March, almost nothing.
Okay, really? So okay, fair enough. That's good. Now you said right now you're looking at going and doing. Okay, wait, hold on. You raised the $4 million back in February 2018. You were still pre-revenue at that point. So what the hell were you selling, Ross?
Well, what I was selling was we were growing 10% week on week.
But growing what? You said you were pre-revenue.
Customers. So we were charging that it was transactional revenue. It was just transactional revenue.
Okay.
And we were really getting bite in the market. We understood we could acquire customers in an efficient manner, and they loved our flow and really consumer friendly flow. At that time, we had just figured out a couple of SaaS-based products. One of them is called Registered Agent. It's built into the business. And then there's another one which we created. It's called the Worry-Free Guarantee. So you pay a subscription, and we make sure that your entity stays in good standing. We do regular good standing reports, and then we do your annual filing and franchise tax is all part of the product. So right out of the gate, we were a SaaS-based business.
Got it.
That was just what we launched. Since then, we've launched SMB, products where we're getting even more revenue.
Ross, so why is now the right time to raise? You said you're thinking about raising more.
Because we're going over some magic numbers here pretty quick.
Like what?
Millions in recurring revenue.
Oh, okay. So yeah, once you pass obviously $83,000 a month, that's a nice inflection point to hit. Talk to me though about some of the other important economics. So typically, we've had the folks from EIG, Constant Contact, these kinds of folks on the show, and churn in the SMB segment is through the roof because their businesses go out of business. So what's your churn and how do you keep it low?
Yeah, I'll tell you what, this is a great question. And we're very focused right now on acquisition and driving up the LTV of these products. And we've launched packages where we package up solutions for our customers, which makes it even easier for them. We can throw in, if you think of a SaaS-based model, a lot of stuff we have built, like we have an operating agreement product, which our margins on are nearly 100%. So we can throw these kinds of products into our SaaS packages.
Well, so what do you assume lifetime value is today on an account?
Well, I'll answer that question in that our acquisition model is CAC based, of course, and we want to get a payback within 12 to 18 months from an LTV point of view. So we're doing very well on that, and there's lots of expansion. I will tell you that $17 number I quoted you was literally a 2x expansion when we launched our packages.
So Ross, an 18-month payback period, which is your worst case you just cited, on someone paying $17 a month is about $305. You're saying you're willing to spend that full $305 up front to get the customer in the first place?
No, we aren't paying that much.
Well, then how do you get to, what do you mean 18-month payback period?
We're less than 8.
Okay, so you just said 12 to 18, so I'm using your number. So even if it was a 12-month payback.
Sometimes it's under, sometimes it's over. It is seasonal. When you're doing Google AdWords, it's seasonal for our keywords and where we're active.
But I just want to generally speak. I understand it changes, but what you're saying is you've got minimum 12-month payback period, sometimes 18 months. So if you're spending 12 months of LTV on CAC and they're paying $17 a month, that means you'd spend about $200 to acquire a customer, and you make that money back in 12 months.
You're in the ballpark, yes, sir.
Interesting.
You're good. Good on math.
Thank you, sir. So it's mostly direct paid stuff you're doing, or do you have any kind of inside sales team or touch?
So we're doing, background is digital and SEO. So we're doing a little bit of SEO, but again, it's early. We have affiliates, so we have people that are selling our product.
What kickback do you pay? 30% perpetual or just first year or what?
30%.
But just for the first year or in perpetuity?
actually for everything they sell, because right now we want a bigger ticket. So everything that they sell, when we get resellers, they're typically accountants or lawyers, and lawyers can't sell legally, but accountants can. And so we give them a 30% kickback, and we want to give it to them forever so that they'll have a bigger ticket and so that they'll have recurring revenue. We want to motivate them in that fashion. We also have people calling our API directly. So we have an API where they can.
But Ross, let's say that reseller channel scales really fast. Think of a HubSpot where their value-added reseller network is really what drove their whole thing. You essentially have killed your margin because you have to pay 30% out. So your cost of goods sold already, it takes it down to 70% margin before server costs and other cost of goods sold.
Yeah, I think that, I think it's a high price to pay right now, but we want to get growth and we want to get that network going.
So you'll change that over time.
We can change everything over time. Yeah. One of the things that's a good point to be put out here is, we're a startup. And so if we start getting sensitive about what the hell we're doing, not be able to test things and not be able to get the job done, we can change anything at any time. And we have. Our pricing has changed wildly and will continue to change.
Yep. No, that makes sense. Team size today, how many people?
15 and 2 in Peru, 17.
Okay, very good. So 17 total. And the 15 are all in Austin?
Let's see. 1 is in North Carolina.
Okay, so Austin, Peru, and North Carolina.
One of our lead with for 20.
And Ross, we're quickly running out of time here, so quick answers here if you can. What is your churn today? Gross revenue churn annually?
Yeah, I think we are in the 5% range. You have to, it varies by product. Some of our products have a higher churn. You also have to, in our business, there's a third built right into it of companies that just fail.
Exactly, yeah. That's built into that 5% though, right?
No. Okay. There's a third above it.
So just to be clear, if a company fails, you don't consider them churn because you have no control over that.
Well, we handicap ourselves. So the answer is yes and no. I don't want us to hide it either, because I will come back to, I think that our segment and the way we're approaching our customers is that, if you go after the mid-market and you have customers that have 20 or 30 employees, they have to be successful, right? Yeah. So if they can't make payroll, they're going to fail.
That's right.
But, 70% of our customers are solopreneurs or just single owner LLCs. They don't necessarily have to be profitable. These can be side gigs. These can be bad.
Ross, I totally get it. So do you make up via expansion revenue? Do you more than make up for that 5% loss? So your net revenue retention is above 100%?
Let's see. Say that again.
The cohort that signed up a year ago, you're saying 5% of them will churn. Do you upsell that same cohort enough to make up for that revenue loss?
Yes, that's the idea.
But you're executing that? You're above 100% net revenue retention right now.
100% above. That's a good question. I don't know.
You don't measure it. Okay, that's okay.
I don't measure it. I don't know.
That's okay.
But yes, we are continuing to rapidly grow, and we're looking at retention right now.
That's great.
One of the things, just on our product, we're really after the top line acquisition of customers. Retention is something that we're going after now. We don't even have annual packages, for example.
Yeah. No, makes good sense.
That's a huge one, and we do we want to see where the problems are with our with retention.
Good. All right, Ross, let's wrap up here with the famous 5 one-word answers if you can. Number 1, what's your favorite business book?
Man, I wasn't prepared for that.
That's okay. You can skip it.
You know what? Your book. Absolutely. Your book.
You haven't read it yet. You're just looking at the thing going, I'm going to make Nathan feel good. And
man, that's it. I'm telling you, I'm going to read it, and it's going to be my favorite book. I can tell you.
Listen, you're high. You need a job. You need a job. You can be my head marketer.
No, I really think it's the innovator's dilemma.
Okay.
I think that's probably, if you consider, that's certainly a business book.
It is.
But it's more than that.
Number 2, is there a CEO you're following or studying?
No.
Number 3, what's your favorite online tool to build a business?
Oh my God. That is the perfect question for me.
What do you manage sprints in? Like Jira?
Pardon?
What do you manage your sprints in? Like when you talk with your development team and plan, what do you use?
We use all the Atlassian tools
Atlassian, okay.
from Confluence, Zero. But, let me just answer that question just in general. I'm old enough. At Excite.com, we built friggin' everything. I mean, we built plugins for web servers that would handle, just absolutely everything. And I will tell you, even with Homeaway was old enough that we hosted everything and we built a ton of software and integrated a ton of software. What you can do now with the tools that are all subscription based and technology is just, we have a mantra here.
Saves your time.
We have a mantra here, which is, you know what, folks, we are not building any software here. We're only building the critical pieces that add value. We use everything possible from a SaaS-based solution.
That's good. We'll say Atlassian for now. Number 4, how many hours of sleep do you get every night?
How many what?
Hours of sleep.
Oh, my God. Last night was a bad night. Probably about 4 last night.
Okay, but what
I sleep like a baby. I sleep for 2 hours and I get up and cry, and I sleep for another 2 hours and get up and cry.
Last question here, Ross. What's your situation? Married, single, kiddos?
Married, 3 kids, happily married for 30 plus years.
Amazing. And how old are you?
I'm 55.
Take us home here. What do you wish your 20-year-old self knew?
What? Pardon? What's the question?
What's something you wish your 20-year-old self knew?
To go to Burning Man.
Have you been?
Oh my God, yes. I love it.
I love it. Guys, go to Burning Man earlier. He sold his first company, well, not his first company, but his second, third company, Homeaway, to Expedia for $3.9 billion. Now he wants to help small businesses here in Austin, Texas. Took over a company called Zen Business in 2016 as an investor, and then obviously got a bunch of equity for that as well. Now has 6,000 SMBs using him, paying on average $17 a month. So he's got about, call it 100, 110 grand in pure SaaS revenue, but he's got also other upsells that are helping him drive LTV on these accounts. He's done this just by only raising $4.5 million, which is great. 17 folks on the team between Austin, Peru, and North Carolina, 5% gross revenue churn annually, spending up to 12 months of LTV to acquire the customer, mostly paid stuff. He's trying to figure out top of funnel before he goes out and raises again. Ross, thank you for taking us to the top.
Hey, great time. And I am flattered to be part of this.